Next, we'll go through what are the 7 entrepreneurial finance principles. We're going to go through each of the 7, and we're going to summarize each of them as we go. These are at the core of a lot to do about ventures, but certainly having to do with venture finance. First, resources are critical for the success of a venture. What are the resources needed, and how do you pay for these resources? Because we know resources are scarce. The fact is that it's not just money. There are real human and financial capital that need to be deployed in order to succeed. And one way to think of this is it's a rental. Now, when you rent an apartment, you use the apartment, you pay the landlord money, and therefore it's a closed transaction. The landlord gets return on their investment, you get the use of a place to live and work. Now, we can think of other forms of capital in the same way. Human capital. This might sound a little odd, but when you hire someone or when you contract an independent contractor, you're renting their time and expertise for a return of some money. And it's a similar thing to a landlord, except now the resource is more intangible and yet very valuable. Third is money. Money doesn't come free. No one just gives you money unless you're inheriting money. So when you get money, there is an expectation of some return, what we call return of and on capital. Return of means you give back the money that was lent or invested in your company, and return on, which means that for the privilege of using their money, you get to pay them some return, the providers of capital. So think of this idea of resources are essential. It's not all money, and the basic idea is they're rented. And there's some dimensions that are very relevant in your negotiations and the conduct of your startup. One is there's a time value. Certainly when it comes to venture capitalists, they have very high expectations for a rate of return, and they like things fast. They like to have things grow quickly, for it to become leaders in the market, and for them to exit or harvest their investment with some takeout, either through an IPO or through a sale transaction. But in this field, as you would expect, there's a lot of risk. The risk of failure is high. The probability of success is low. These are not necessarily good odds. Again, it's an exhilarating chase when you start your business, but it is fraught with danger and peril, right? So enter at your own risk. Then throughout this process, you find the invisible hand, where there is not really a shortage of money. What there's a shortage of is high caliber, high probability, successful ideas. And every entrepreneur thinks they have the one that's going to make it. But in practice, reality, history, data, we see that the probability is low. So why is it that your venture deserves to succeed? And it needs to prove itself in the marketplace. And this is what we're going to look at, is how do you sort through ideas from those that are really worthy of your time and an investor's money. So the first step is that we have real human and financial capital, and we rent them. Second, what is the core principle that governs how an investor views the investing and the pricing of the shares in the case of a stock investment? So risk and return go hand in hand. If we have more risk, they should get more return. How much more is the market determines this, right? So there's no formula. We have many formulas, but in real life, when we look at the pricing of a security or the market valuation of a startup, there are rules of thumb, there are guidelines, there are all these things, but ultimately it is what is the merit of your specific idea. And with higher risk, the expectation is higher return. So does your venture warrant the risk for money to be invested? So this is the basic idea that runs through all of finance, as you know, of risk and return are highly correlated. Third, what is the most important financial accounting metric for a venture? You learned in your accounting and your finance classes things like earnings per share, cash flow growth, share price appreciation, growth in asset returns, things of that sort. But what is the most important one for a venture? Answer, in a word, is cash. Because without cash, your company is dead, and there is no presumption that anything you do operationally will generate cash. In fact, early in the venture's life, you often burn or use cash. So what we look at is we want to look at the tracking and accountability of all the actions we take, and it eventually ripples into cash flow. So it is the lifeblood, and there are terms. More lingo for you is we have a term called the burn or cash or burn rate. All these things that relate to have the word burn. It means that as you're investing and spending cash, what is that rate? And based on how much cash you have on hand, how long will it last? So we're constantly raising money, constantly managing money very frugally in order to be able to get our airplane off the ground. So along with the concept of burn, a painful phrase, is another colorful phrase, which is runway. So we say, what is your runway? How long do you have for your plane to take off when you're starting out? And the longer the runway, the more chance that your airplane has momentum to take off. The shorter the runway, the more perilous it is that your airplane will take off the ground. Cash build is what we want. We want to be able to have excess of the cash we receive over the cash we're distributing. Again, doesn't happen much in early phases of a company, but we want to work toward this where the burn rate goes down, down, down based on our spending control and the cash generated from running the business, from getting revenues from our customers. Fourth, what makes venture financing different from what you've seen for financing of established, say, Fortune 500 companies? Answer is new ventures have to have search, negotiation, and privacy. These are characteristics of the venture markets that you're not seeing in the more established securities markets. So we have on public markets common contracts. We go public with common stock. We have issuances of preferred stock. We have bond transactions. These are very well organized and fairly standardized. I know no two securities are 100% identical, but they're more similar than not. And certainly when you compare it to the types of instruments we use in financing private companies. Now, the private companies, we have contracts that are not standardized, and they're highly negotiated between the providers of capital and the companies. And we'll go through the legal and financial components of these financings during this course. And the one that we'll pay the most attention to is the term sheet that we'll get from kind of early angel and venture capital investors. Fifth, who are the stakeholders and what are their goals? Answer, our goals, we want to be aligned. This is true of all aspects of business and life. If two or more parties are together, we need their interests to be aligned, or there will be conflict, dispute, or some falling out. And we each have our own motivations and priorities, but ventures share one goal, and that is we want to increase the value of the venture. That keeps everything together. Although there might be some trade-offs along the way for your personal life, your lifestyle, how lavish things are, one thing is true, that as long as the venture is creating value for all those involved, it's going to be a lot easier to have the group stay together. And so that's why we're focused on market value. Notice we did not say sales profit or in fact, even cash flow. What we're really fundamentally there to do is to create a venture that has market value. That holds all the parties together. 6, different stakeholders have different motivations. What is the motivation you can always count on when you're looking at individuals? The answer is that everyone will look toward their own self-interest. Some people look entirely toward their self-interest to the ignoring of all other interests. That's a little bit myopic. Others appear more generous, more considerate of other people. But in the end, our best way to make sure we're keeping everyone together is that if they simply look toward their self-interests, that they would do this. And that holds for investors, employees, managers, etc. 7th, what are the non-financial characteristics of financing of a business? The answer is there's a character and a reputation dimension where it can be an asset or a liability. Asset is pretty obvious, that if you have high standards, it is appreciated and recognized, and that will lead to customers, employees, investors, bankers. And so we also notice that we can make societal contributions. This may not just be altruistic. there is good business reason to do so as well. People are proud of working with a company that has good values. People are proud to be customers of companies that provides products and services within positive social values. Character and reputation matters. Also, what you'll find, particularly in Silicon Valley, is that everyone knows everyone. So if you have a reputation from some prior job or position or even school, that is discoverable. A venture capitalist can very easily find a way to do due diligence on the people that they're about to finance. Maintain at the core integrity and honesty, hard work, all these values that you know to be important, because in the end, we hope that what goes around comes around, that those aspects that are positive will reward you with a long career. So what are the 7 principles? First is that we rent capital from those who have capital. Those could be real, human, or financial. That risk and reward are explicitly tied and drive financing for venture. Third is cash is king. It is what we guard to have cash on hand, to provide long runways, to lower the burn rate, and to make sure we have the resources to sustain the attack. Fourth is financing is much more complicated. It's negotiated and is done with very private transactions, which have a lot of variation in them. Fifth is that we want to increase the value of the entity. This is what unifies all the stakeholders in a venture. Sixth is, although we all want and believe otherwise, people are at their core interested in their self-interest. We would like to have people that have broader, more altruistic, and more company-oriented goals. But at the core, let's make sure we take care of their self-interest as well as the other motivations they have to join the team. And seventh, character and reputation matter for you, your company, and the employees and managers in it. We adhere to these 7 principles, and there's no guarantee of success, but it is worthwhile to say that if you're ignoring these, that your chance of success are greatly diminished. Now to learning objective 4, and I'll just call this venture capital lingo. And we're going to see a lot of things over the time. We've covered a few of these in terms of the stage, we call it. What stage are you? It could be developmental stage, otherwise called seed, startup, survival, rapid growth, maturity. We saw this on the S-curve a bit earlier. Next, in financing, there are terms. The first is bridge financing. I once was with a company seeking some financing from our venture capital, and we had not yet met our milestone. And so therefore, it's a little bit premature, not a very friendly or comfortable conversation with a financer. And the VC partner said, is this a bridge or is this a pier? And that was very vivid to me, because a bridge, like the San Francisco Bay Bridge, goes from San Francisco to the other landmass called Oakland, right? It goes from one safe spot to another. A pier is like Pier 39, where at the end of the pier you keep going and you end up in the water, in the bay, and wet. And so bridge financing has that very clear intention to get you from where you are now to another place, hopefully that has an increment in value. Next are series. So you'll hear the term, I'm in my series A, I'm in my series B, etc. Or even without the word series, I'm in my A. You're in your A, you're in your B. What do you mean by that? What they mean is it's their first round of venture capital financing or venture financing. And first is A, B, C, etc. Right? So that's the nomenclature that we use when we talk about financing of a venture. The third topic here is a mezz or mezzanine round. Mezzanine, if you think of a building, is in between, say, the ground floor and floor 1. There's a mezzanine. What it means is you're not on the ground floor, you're not on the first floor, you're in between. So a mezz round used in financing is that you're in between your life as a private entity and your life as a public entity. So it's seen as a last round prior to an IPO. That's what mezz round means. Not between A and B, but between your last series as a private financing to your IPO event. Next is seasoned securities offerings. So seasoned doesn't mean like you're a seasoned person like me. It means that there are offerings that have now been in the market and now are stabilized. And that's something we all seek to have. Sources of financing, and the stairway will cover this in much more detail, is we have organized venture capitals who raise money from institutional investors and then use that to invest in promising young companies. There are angel investors who are individuals who finance at earlier, more risky stages, and they do so for many reasons. They want to make money, of course, but many of them really enjoy the thrill of the chase, of accomplishing things. So we'll talk about this, of course, in this class. And investment bankers, they're at the end of your journey because they lead you to the IPO or to a merger and acquisition. So summarizing chapter 1, we are jumping into the entrepreneurial side of finance. So therefore, where's the opportunity come from? It comes from many, many places. It just requires some creative and critical thinking. Next is to know the life cycle of an idea of a company and how that will lead to financing alternatives that open up, frankly, the further you get along your S-curve. Next are the principles for entrepreneurial finance that will govern not only financing, but much of how we view the success and decisions and actions of a venture. And last is some lingo. All right, so that concludes chapter 1, and we'll move on to the next chapter. Thank you.